Preferred returns. Boy, this is one of the most misunderstood concepts of multifamily real estate. Let's talk about this. What is a preferred return? A preferred return on a multifamily real estate deal typically means that the passive investor, the limited partner, whatever you want to call them, is going to get the first X% of cash flow on the deal. Let's pretend like it's 6%. So if that's the case, you're going to get the first 6% cash flow on the deal. And then most of the time, the profit component, right, the 80-20 split or whatever you want to call it, is going to kick in, and then the investor gets 80% of the profits and the sponsor gets 20. But that only happens after the preferred return is paid. So that's what a preferred return is. Now, let's talk about why it's misunderstood, right? I'm going to go through the pros and the cons, and I want to walk you through it, because when you understand how these things work and the impact it has on the deals, you might have a different opinion than what you have right now. First of all, preferred returns always feel like they put you first, and they kind of do. But the reality of it is, it only matters if the deal doesn't do well. Let's take my 6% preferred return example, and let's say that after that it's an 80-20 split. If the deal does 7.5% or better, the preferred return doesn't matter, because there's enough for everybody to get the cash flow that they're hoping for. It only matters if the deal doesn't perform that well. That's what's really important for you to know. Secondly, it does ensure that you get the first, in my example, 6% of the cash flow. That it does do, a box check for sure there. Here's the biggest misunderstanding. It is not a guarantee. Everybody thinks the preferred return is a guarantee. And what I see a lot of investors do when they hear a preferred return, let's in my 6% preferred return example, they're just taking it to the bank. This is going to generate 6% cash flow every quarter. And it's not a guarantee. Nobody can guarantee you that preferred return. What it means is you're going to get the first 6% of the cash flow. And if there isn't enough cash flow, typically what isn't paid will accrue, right? So that means that the sponsor has to pay it before the sponsor gets paid. So just know that it's not a guarantee. Now, what's wrong with a preferred return? And I've been on both sides of this as an investor, as a sponsor, so I really have a pretty good understanding of how this works. Again, I said most of the time it doesn't matter, right? Especially in our deals, there's no guarantees with anybody's deal, especially ours, but we've generally done quite well. So, our deals generally do better than 7.5%. I would consider 7.5% annual return on one of our deals to be a huge failure on our part. So it usually doesn't matter in our case. Secondly, and this is probably the most important, but when you think about how this happens, you'll understand how this actually hurts you way more than it helps you. So now I'm a sponsor. I'm out looking for deals. I found this screaming deal. I love this deal. It's awesome. It's in a great neighborhood. Everything's perfect about it, right? Well, it's never perfect, but close. So here's what I have. But here's the problem. The problem is it only throws off 4.5% in the first year, maybe 5.5% in the second year. And after that, it really does really well. But I just believe there's so much appreciation here because rents are way under market that I believe there's going to be huge appreciation. So I love the deal. Here's the problem. If I have a preferred return, now I got a serious problem. So I got three things that are going to happen. Let me explain how it works. Let's pretend like I, as a sponsor, go ahead and do the deal, put our investors in it, and here we go, time to distribute cash flow. Oops, there's only 4.5% there. And so I distribute the 4.5%, and the investors, even though I told them, even though they kind of understood this, they have a full expectation they're going to get 6%. And I only sent them 4.5%. They're going to be disappointed. Right? And if you're in my chair, if you're a sponsor in a deal, the last thing you want to do is disappoint your investors. That just never goes well, especially right out of the gate. You don't want to do that. You don't want to tell them one thing or have them believe one thing or have them perceive one thing and then you deliver another. Never a good situation. So let's go to the second solution in that situation. Well, I know that I run the risk of disappointing my investor if I do this deal. So I reach into my pocket and I pull out the other percent and a half, whatever it is that it's short, and I fund the preferred return out of my own personal pocket. I mean, nobody's going to do that. As a sponsor, you can't do that. It just doesn't make sense to do that, so nobody would ever do that. So we have two scenarios here that aren't good. So it leads you to the third scenario. You don't do the deal. And everybody misses out on making an enormous amount of money because the sponsor literally handcuffed himself or herself with this preferred return, because two of the three scenarios don't work out well disappoint either the investor or make it impossible for the sponsor to have a real ongoing business, so they pass on the deal. Here's the reality of multifamily real estate, and it's always been this way for us. Cash flow is important. If you're a cash flow investor, I'm with you 100%. I enjoy the cash flow too. But the reality of it is cash flow is only a small part of it, yet it drives the big part. Let me explain this. Cash flow is generated, and you're getting paid while you're waiting for this appreciation to happen. While we're doing our thing on our deal, right? We're raising rents, we're improving cash flow, we're doing all the stuff we're supposed to do to increase cash flow. Why do we do it? It's not really done to distribute more cash flow to you, although that certainly is a possibility. The reality of it is, when I'm able to move cash flow and increase cash flow by a lot, there's a pretty good chance somebody's going to pay me more for that asset. And I mean a lot more. For every dollar I'm able to increase cash flow, I can typically get 18 to 20 times that in new value. Like, that's massive. That's how you make money in real estate, right? So now, because of this little preferred return issue, back to my example that I handcuffed the sponsor had to, that would be me, had to pass on this deal because of this preferred return issue, and everybody misses out on a really, really good deal and an opportunity to make a lot of money. Here's the other impact. So now let me just create another scenario for you. Let's pretend like sponsors got lots of deals going on, and most do, right? If they're growing their company and they're doing it responsibly, they've got a number of deals going on. There's only so much time in the day. So now you got all these deals that are doing well, maybe with no preferred return on them, right? Everybody's cash flowing, everything's going well, but you have this one deal, has a preferred return requirement, and maybe you're just making it, or you're a little bit short, so you're distributing as much as you can. And that is the time when you need sponsors to really stay focused on that asset, to improve it, to make it get through the problem, whatever problem it's having, so that you can make money. But guess what happens? When that sponsor, and I'm not saying we do this, but I'm telling you this happens in this business all the time. When the sponsor has a finite amount of time, are you going to spend your time on deals that are making you money? Or are you going to spend time on the deal that is not making you money and seems to be going backwards? You know the answer to that, right? This creates the dilemma for a lot of sponsors. I've seen people do this. I've seen sponsors do this, and it actually hurts the deal. It actually hurts the long-term viability and profitability of the deal, because now you have a sponsor who maybe believes they're going to pile a lot of time and energy and focus on this deal, and it's not going to pay them. And they're going to ignore all these other deals that are making them money. You see what happens? You want them paying attention. So what happens in the preferred return scenario is you have the very real risk that you misalign your objectives and the sponsor's objectives. You don't want that. You need these to be lined up perfectly. You want that sponsor to always be in a situation just like you to make money all the time. Because if they're not, they won't put their attention on it. I'm telling you, this dilemma, I watch this happen all the time in this business, and it is the biggest drawback to preferred returns, other than the fact that you're missing a lot of deals that you should be doing as a sponsor, but you can't because you handcuffed yourself with this preferred return issue. All right. If you found this helpful, please do me a favor, subscribe to the channel, like the video, leave some comments, right? I'd love to answer your questions. If you're interested in figuring out how this business works, or you want to look at investing passively, just go to our website, KRIpartners.com. You'll be able to figure out, give us a ring at 216-290-1710. You can also text that same number, and we will get right back to you and help you figure out how to best put yourself in a position so you can make money in multifamily. If you like the content that we've shared here, please be sure to subscribe to our channel and hit the bell. So thank you again, and have a wonderful day.